It's been a chaotic 24 hours in the silver market. Violent, unnatural, and absolutely impossible to square with what's happening in the real world. Silver didn't pull back. It didn't cool off. It didn't correct. Silver was taken down. In just 2 hours, silver prices were smashed 22% lower. $17 erased. An event so statistically extreme, it's being described as a 12 sigma move. Something that, in theory, should happen once every 7 trillion years. And yet it happened on a random weekday, while inventories are draining, while deliveries are surging, while physical silver is vanishing globally. This is not volatility. This is not discovery. This is a stress fracture. And over the next few minutes, we're going to walk through exactly what just happened, why it matters, and why silver stackers have every reason to be both furious and laser-focused right now. Before we go any further, take a second to support this channel. Like the video, share it with someone who needs to understand what's happening in markets right now. Subscribe if you haven't already, and leave a comment below. This channel exists to cut through price noise and focus on structure, supply, and real-world signals, especially in moments like this, when the headlines are loud but the truth is buried. Your engagement tells the algorithm this conversation matters, and it helps get this information in front of people who are still relying on paper prices to tell them what's real. Let's get to it. Over the past 24 hours, silver experienced a synchronized repricing across major futures exchanges, including COMEX and Shanghai. Prices dropped sharply in a compressed time frame, driven by forced selling, margin calls, and the rapid unwinding of leveraged futures positions. Analysts tracking order flow noted unusually large negative net volume spikes, a pattern typically associated with concentrated selling rather than organic price discovery. This kind of move reflects stress in the derivatives market rather than a sudden collapse in physical demand. Futures contracts are highly leveraged instruments, and when volatility spikes, price can gap lower as traders are forced to liquidate positions to meet margin requirements. In this case, the speed and depth of the sell-off strongly suggest a coordinated deleveraging event rather than a reassessment of silver's underlying value. That distinction matters, because while paper prices were collapsing, there was no corresponding surge in available physical metal, no spike in inventories, and no evidence that buyers had suddenly walked away. Price broke, structure did not. And that should unsettle anyone still pretending this market is functioning normally. This is what a paper market does when it's under pressure. You don't raise margin requirements quietly. You break price violently, because anyone watching closely knows this didn't relieve pressure. It transferred it. Price cracked. Structure didn't. Metal didn't move back. It moved out. What's happening on COMEX? At the same time silver prices were being aggressively repriced lower, COMEX Vault data told a very different story. On a single trading day, more than 3 million ounces of silver were removed from COMEX inventories through a combination of withdrawals and reclassifications. Metal left major vaults including Asahi, HSBC, Brinks, and JP Morgan, while overall registered inventory continued to shrink. Total COMEX silver inventories now stand just over 400 million ounces, down more than 3 million ounces in one session. This drawdown coincided with an unusually strong surge in physical delivery demand. By the third day of February alone, delivery notices issued and accepted were already approaching 3,000 contracts, equivalent to roughly 15 million ounces of silver. That figure exceeds the entire February open interest observed in January. This behavior indicates that futures contracts are increasingly being used as a pathway to physical delivery rather than as speculative or hedging tools. When traders buy futures specifically to take metal off the exchange, it signals declining confidence in paper settlement and rising urgency to secure physical supply. Prices falling while deliveries accelerate is not a sign of abundance. It is a sign of strain. Physical silver is gone, and the world knows IT up to this point. We've been looking at the surface, the price collapse, the futures repricing, the official data, the dealer reports, and the policy signals quietly forming in the background. But none of that answers the most important question. What does this look like from inside the system, from the vaults, the delivery pipelines, and the physical hubs that actually move metal? Reports from physical silver markets around the world directly contradict the message implied by collapsing paper prices. In Dubai, Buyers are reportedly paying premiums as high as 15% to secure physical silver, with inventories described as exhausted and new supply appearing sporadically, only to be purchased immediately. Suppliers are increasingly unwilling to guarantee future delivery timelines, reflecting uncertainty in sourcing and logistics. This pattern is consistent across multiple regions. Rising premiums, depleted inventories, and delayed fulfillment are classic indicators of physical market stress. They do not occur in environments of oversupply or weakening demand. This is textbook physical stress. Rising premiums, vanishing stock, uncertain timelines. This is the physical world pushing back against paper fantasy. This reality was confirmed directly by Bullion, one of Asia's leading bullion dealers, now operating in the United States and New Zealand. In a public statement, Bullion reported, "Quick update on the ground. The physical market is under serious stress. Silver especially, near impossible to source. Mints closed, refineries backlogged, most competitors empty. We have inventory because we planned ahead. That said, premiums are set to reflect real physical market conditions. We've reduced both our buy and sell minimums from 20,000 Singapore dollars to 10,000 Singapore dollars, and we'll continue to monitor the situation. Access to physical metal matters, especially during times like these. We're committed to lowering it further as conditions allow." Read that again. Silver is near impossible to source. Mints closed. Refineries backlogged. Does that sound like a bull market that ended last week? Or does it sound like a system cracking under demand it can't satisfy? In addition, reports have begun emerging from Switzerland, one of the world's most important precious metals refining and storage centers, confirming that silver availability is tightening rapidly, not easing. At the same time, COMEX inventories are not just declining, but draining at a pace that suggests rising urgency among those still able to take delivery. This is not anecdotal chatter. This is metal moving, fast, out of systems built on confidence and paper substitution. In the next clip, Clive Thompson walks through what he's seeing on the ground. Shortages spreading in Switzerland, delivery stress intensifying, and COMEX inventories bleeding ounces at exactly the moment prices are being smashed lower. His analysis helps explain why this kind of price action doesn't resolve pressure. It concentrates it.
I can't speak for every country, but I can talk for Switzerland. I spoke yesterday with a trusted person who works for one of the largest bullion dealers in Switzerland. They have zero stock of silver, zero, and they haven't been able to get any for many weeks. They do have silver coming in the door from people who are selling it, but the second it comes in the door, it's instantly sold. So everything which is coming in is being sold. They have nothing in stock. You can't, if you ring them up, you won't be able to get any. As far as gold is concerned, they're out of all the coins, all the small bars, and the only gold they have left are the 250 gram bars, the 500 gram bars, and the 1 kilogram bars. All the small stuff is gone. So that's the reality in Switzerland. And I know I tried to go into this particular, the Geneva branch of this particular large bullion dealer about 2 weeks ago. And I'm a regular customer there. I'm regularly buying. They know me very well. But on this occasion, it's the first occasion ever when the man at the door said, "Look, I'm very sorry, sir, but we've got so many people trying to come in the door. We're only doing it by appointment at the moment." So this was a Monday. He said, "You have to make an appointment, and the earliest date we can give you an appointment will be Thursday." Wow. And I said, "Well, I'm awfully sorry, that's not going to be convenient for me on Thursday. I'll let you know when I can come." Now, it was a great shame that I didn't insist, because I was planning to buy if they would have had it, which I now know they wouldn't have had it, the latest 2026 coins, the gold and silver coins. I like to get all the different collections which are out there. I like to get the latest year, not the bullion coins, but the collector coins. Things like the Chinese panda, things like the Australian lunar collection, things like the Queen's Beasts of the UK, things like the wild animals of Canada, and then there's the Spanish collection, which I can't remember where they got they got the horse. There's a couple of others, which I think they're only on the 3rd or 4th of that collection. So I like to get the new year when I can, because with these collections, they're all limited supply. Once they're sold out, they're sold out. But I couldn't get them. I couldn't go in because they wouldn't let me in. And in fact, it would have turned out if I had got in, they wouldn't have had it anyway, from what I'm hearing now. Considerably, it's many multiples, in fact, higher than the eligible, than the registered silver. The registered silver is what can be delivered. It's also higher than the combination of eligible and registered combined. Eligible is what's not, which is the right shape and size in the right place, but hasn't yet been allocated for delivery. But so all the COMEX silver in storage is not sufficient to meet all the contracts which are outstanding. And the number of contracts which are outstanding have been rising for the March delivery. And that's just 1 month, okay? It's not talking about February or April and so forth, but March is the big one. March is really, really big, which is why I'm talking about March. Now, it could well happen, and probably will happen, that before we get to March, many of those people who are long or short will close, each side will close their positions, and then there will be no problem in the delivery of the silver. However, I have observed that every month of 2025, the amount of silver being called for delivery was many multiples of what was called for delivery the year before, 2024. And in January 26, the amount of silver called for delivery in maturing COMEX contracts was double the year sorry, not double, I think three and a half times what it was the year before, 2025, which was 2.5 times the year before that. So we're talking about 7 times as much silver was called for delivery. The person who bought the futures actually want it, as opposed to rolling their contracts forward, as 2 years ago, as 2024. So we're seeing a large increase in calls for delivery. And that means that when we get to March, it may well be that a large percentage of those futures contracts, instead of being rolled over or closed out, are actually called for delivery. We don't know, because we don't know who's behind it. Anyone could be behind it. Could be multiple parties or one major party. I think it's multiple parties. But if they're all calling for delivery, the silver just isn't there.
Now zoom out. On Wednesday, as physical silver disappears, as COMEX drains, as futures are violently repriced, more than 50 nations convened in Washington for the inaugural Critical Minerals Ministerial, a meeting explicitly focused on securing supply chains essential to national security, technological development, and economic stability. Silver, while often overlooked in mainstream commentary, is a key input in electronics, energy systems, and defense technologies, placing it squarely within the scope of these discussions. During the meeting, U.S. Vice President J.D. Vance announced plans to establish price floor mechanisms for critical minerals, a policy approach designed to stabilize supply by preventing prices from falling below levels that discourage production. Reuters further reported coordinated discussions between the United States and Mexico, the world's largest silver producer, aimed at addressing vulnerabilities in critical mineral supply chains, including the possibility of price floors for certain mineral imports. Mexico mined approximately 6,300 metric tons of silver in 2024, significantly outpacing China and other producers. Any coordinated policy involving Mexico has immediate implications for global silver supply dynamics. The timing is difficult to ignore. Paper silver prices collapse violently. Physical markets remain tight. Inventories drain. And governments begin discussing price controls and strategic supply coordination. That sequence does not suggest a market losing relevance. It suggests one being quietly reclassified. To wrap things up, we need to look at what just unfolded in the Shanghai silver market, because this may be one of the most extreme and revealing episodes in the history of Asian commodity trading. During the morning session alone, 1,396,553 contracts were traded on the SHFE April 2026 silver futures contract. On a notional basis, that represents approximately 674 million ounces of silver changing hands in a matter of hours. When total morning trading across silver contracts is accounted for, the volume rises to roughly 1.34 billion ounces, nearly double the world's annual silver mine supply. That number should stop you cold. This was not incremental hedging. This was not retail enthusiasm. And it was not reflective of any real-world increase in available metal. It was an overwhelming surge in futures activity, leverage colliding with leverage in a market already under visible stress. Now here's the critical part. Despite this unprecedented paper onslaught, Shanghai silver prices remained at a substantial premium to COMEX and LBMA equivalents. Even after the attempted price suppression, the market stayed in backwardation, a condition that typically signals immediate physical tightness rather than excess supply. In other words, even one of the largest paper sell events in commodity history failed to break the underlying structure of the market. That tells you exactly what kind of event this was. This was a deliberate, concentrated short-selling attack intended to smash price, not to reflect reality. And then came confirmation. Earlier today, the Shanghai Futures Exchange announced regulatory action against 6 groups of accounts that exceeded daily trading volume limits and violated abnormal trading behavior rules. The exchange confirmed it is restricting these accounts from opening new positions in the affected contracts. Translation: they tried to break the market, and they were caught. This wasn't speculation gone wrong. This was an intervention that failed. At this point, the divide could not be clearer. Paper silver and physical silver are now openly at war. Paper shorts managed to push prices down 22% in 2 hours. At the same time, physical silver is being drained every single day. And the most telling signal of all is still coming from COMEX. Under normal conditions, only 1 to 3% of futures contracts ever result in physical delivery. The rest are cash settled, rolled, or closed out. That's how paper dominance is maintained. But now, we are seeing near total physical settlement. That is not a functioning paper market. That is a delivery market under siege. You cannot build AI data centers with futures contracts. You cannot manufacture weapon systems with unallocated ounces. You cannot electrify grids, expand solar capacity, or secure national supply chains with paper promises. The world is not short of silver exposure. It is short of silver. If this analysis helped you understand what's really happening beneath the price action, hit the like button, share this video, and subscribe to the channel so you don't miss what comes next, because this story is not over, and the next phase won't be subtle. Most importantly, leave a comment below. Are you watching price or structure? Do you believe this paper breakdown ends quietly or violently? This channel exists for people who refuse to confuse leverage with reality. And if you're holding real silver, you already know which side of this divide you're on. Thanks for watching.